Welcome to this week's edition of Weigh the Options. Weigh the Options is a video series where I take a look at 5 potential options trades that I'm thinking about taking for this week. Now, Weigh the Options is a members-only video series. If you're a member of the channel, you get immediate access to Weigh the Options every Monday as I put these out. If you're not a member of the channel, unfortunately, you have to wait 1 week before the video is publicly available. So please help support my channel and get immediate access to these videos by clicking the join button to become a member of the channel. It's only $5 a month, and again, it does help support my work. So the very first trade I want to talk about is ON Semiconductor. Now, they reported earnings this morning. I'm recording this on Monday, November 3rd. They just reported earnings this morning, but they still have some decent IV rank even after earnings. IV rank of 28, it's not terrible. IVX of 56% in the 46-day cycle, really good IV. So now you've already passed the earnings event, so you don't have that binary event risk with the earnings, right? So now's the perfect time, I think, to go potentially do a post-earnings strangle because it still has some decent IV. So if we go to the 46-day cycle, I could sell the 25 delta put and maybe the 22 delta call. Now that's really tight when it's not dollar-wide strikes here, unfortunately. So a lot of times I would like to go more of like 16 deltas on each side, but 25 delta put, 22 delta call is not a horrible trade for a 270-cent credit on a buying power reduction of $506. Really good risk reward. The pop on the trade is 67%. If you hold it to expiration, you're going to win 2 out of 3 times, right? Now, I never hold to expiration. I always take my profits at 50%. And the P50 number is around 75 to 80%. It's moving around a little bit because the market is open right now. And if you want to widen this out, at some point they will add dollar-wide strikes to this expiration, and later down the road, if you want to widen it out, you certainly could, or potentially roll it out another month if they have dollar-wide strikes in the next month. So just because you start the trade as this essentially 25 delta on each side strangle doesn't necessarily mean you have to keep it there. At some point, you will be offered the chance to adjust it. If you wanted to widen it out now, because of the $5 strikes, your only options would be to go the 11 delta put, which doesn't really have a bid-ask spread, right? It's 1 penny by $1.20. You can't trade that, right? Nobody's trading that option. You have to do the 25 delta put. The call, you do have a 14 delta call, so you could get a little wider on the call side if you really fear the call. Now you're getting a 218 credit on a buying power reduction of 480. That's a perfectly acceptable trade. For those of you that fear calls altogether, it's also a perfectly acceptable trade to just sell the 25 delta put. 161 credit on a buying power reduction of 510, but for me, I would probably do the tight strangle here with the understanding that at some point I'll probably widen it out once they add me some more strikes to play with. The next stock I want to take a look at is one that reports earnings today. So right after the close today on Monday, November 3rd, Shopify. I often play Shopify for earnings. It's always got pretty decent IVX. So the IVX here, 62%, really juicy IV. You can see the IV rank of 44, very nice. And anytime I see something with really juicy IV, immediately I think strangle, because if you're going to give me really good premiums on short options, then selling one doesn't make sense. Selling 2 makes sense, especially you're going to sell 2 for the price of 1 because you're not going to be charged buying power. For example, if I sell this 11 delta put, I'm going to get a 223 credit on a buying power reduction of 1350. Well, for that same 1350 buying power, I could probably also go sell a 10 delta call. Right now, I get 397 credit. The buying power reduction did go up a little bit, so it went up to $1,700 because I guess there's a little more risk on the short call than the short put. But let's say you were just selling the short call, since it has that $1,700 buying power reduction. Maybe you only wanted to sell the call. 174 credit on a buying power reduction of $1,700. It just makes sense to go sell the put because you're getting it essentially as a free trade, right? You're not really getting punished on buying power selling both sides of the trade. So anytime I see something with really nice IV, Typically, I will try to sell a strangle if it makes sense. And in the case of Shopify, it really makes sense. You get way out of the money on these options because of the nice IV. You get a really nice credit. You know, the risk reward's great. The pop on the trade, 83% pop. So that's, if you hold all the way to expiration, 83% of the time, you're going to make a penny or more, right? But I never hold to expiration. It's the P50 number I'm worried about, right? So I take my profits at 50%, and 90% of the time, I'm going to make 50% or more max profit on the trade. So, you know, all signs point to go on this trade. Now, a stock that reports later in the week is Hood. That's Robinhood, right? The broker. They report after the bell on the 5th. So that's after the bell on Wednesday. So I may not put this trade on this morning, but later in the week, what am I thinking about Robinhood? Well, Robinhood been a very strong stock, right? For a long time, it's just been straight to the moon, up, up, up. So for that reason, I'm going to go with the momentum. I'm going to be bullish. Instead of doing a strangle, which a lot of times I would do a strangle, but stocks that just go up all the time, I fear the call side a little bit. IVX, 75%. Really good IV. And man, you know, it's not necessarily wrong to sell a strangle. I can understand if that's the way you want to do it. Nothing wrong with that at all. You get, you know, 464 credit on a buying power reduction of $1,400. And this is like a 10 delta or 11 delta on each side strangle. Really way out of the money on each option. Perfectly safe trade, and it would probably work out for you. But again, for me, I want to put on a bullish trade, just a straight bullish trade. So maybe just sell the 15 delta put for 360 credit, buying power reduction of $1,100, P50 number of 91%. That's really nice. Now, even though I said I'd fear the call side, you know, not necessarily the put side, I kind of do fear the put side a little bit on a stock that's high flying, right? Could this come crashing back down? Maybe. So maybe instead of the naked short put, maybe instead I do a put debit spread. A put debit spread, wait, that's a bearish trade. Yes, I'm going to do a put debit spread. I'm going to pay $1.10 for this put debit spread, meaning the possible win on the trade is $3.90, you know, should the stock come crashing back down. But what I'm going to do is I'm also going to sell an additional short put, turning this into a put ratio spread. Now I receive $250 credit on the total trade on a buying power reduction of $1,200, and now I protected myself a little bit because that extra $1.10 credit that I gave up for the put debit spread that's embedded in the put ratio spread gives me a greater break-even point to the downside. If I go to the curve and analysis tool here, we'll take a look at the risk profile. If you've never seen the risk profile of a put ratio spread, it's a rather unique trade because of the two trades in one. You've got the one bullish trade, the short put, plus the bearish trade, the put debit spread, all combined into one trade. So if the stock slowly moves down over the next 46 days, you stand the chance to make a lot of money if it moves inside the spread. Now, that's typically not how you want to play it, and you certainly don't want that. I actually just want Hood to go up and me make 50% of my profit on the trade and just move on. That's all I want, right? So that's typically how I'm going to play it. But if the stock slowly moves down, it's not the worst thing in the world. The worst thing in the world is actually the stock just crashes down hard right after earnings. But that would be a problem with just the one naked put, right? So now, because you have the one naked put plus the put debit spread, which eases your loss to the downside because it gave you another $400 of protection to the downside, or $4, but it's a $400 profit. You know, it offsets your losses just a little bit, gives you a wider break even to the downside should things go against you. And for me, the one naked short put that's a part of this put ratio spread, I mean, if Hood crashed $50 on earnings, hell, I'll take shares. I'll buy 100 shares at $115 a share because that's a great price on what I think is a stock that still has a lot of room in the future to run to the upside. Now let's get into some more of the semiconductor stocks that are reporting this week. There's a couple of names that are reporting this week. The first one, Qualcomm. Qualcomm reports after the bell on Wednesday, on the 5th, so we'll play this with Hood. So this is another trade. Probably won't put on today. I'll wait till Wednesday to put on. But Qualcomm has an IV rank of 35. If we go to the options chain, go into the table, we have an IVX of 43% on Qualcomm. So, you know, pretty decent IV. Qualcomm is also a stock that typically doesn't make crazy moves. If you look at a stock chart here over the last year, you can see it tends to often trade in a range. You got a little bit of a directional down move here, February, March, April of this year, but that was the whole market was kind of in crash mode. But for the most part, you know, a pretty stable stock. You had the one crazy candle here. That was some news revolving around Qualcomm and a deal with, I think, OpenAI or something. You know, crazy candle there. But for the most part, pretty safe kind of thing to trade. So I don't hate the idea of just doing a strangle for earnings. Let's go 13 deltas on each side. This is 333 credit, buying power reduction of $1,800, so good risk reward, pop of 78, a P50 of 90%. This is another one. All signs kind of point to go on this. Now, if this is another one where for whatever reason you fear the call side of this, you can certainly get even wider. I mean, you could go all the way out to the 7 delta, which is a 240 strike, still get about 80 cents credit or so on that side of the trade. It's a 261 total credit, still a buying power reduction of $1,800. Or if you fear the call altogether, you can get rid of the call, just play the put side, right? Sell a 13 delta put, get 173 credit, buying power reduction of $1,500. That's still not bad. Now your P50 number on just the one side with the put is like 95%, right? So, but for me, I'm probably going to do Qualcomm with the strangle. And then finally, we'll take a look at ARM. ARM reports this week. If we go the overview, it also reports after the bell on Wednesday. So a lot of stuff reporting after the bell on Wednesday. And ARM, I can tell you from past experience, can make crazy moves. I actually lost a lot of money early in, was it 2024? I think it was like January, February 2024, where it made a crazy move up and I had a strangle on. I think I had a couple of contracts of a strangle on and lost like 8 grand, 10 grand, you know, some crazy amount of money playing ARM. And that wasn't an earnings event, which is what's crazy. It did that after it had already reported earnings. So ARM scares me a little bit with naked strangles just because of my past experience. So, you know, just take that for what it is. If you don't fear it, strangle certainly could be a way to play it for earnings. IV rank of 39, IVX 66%, really good IV. But because of my past experience, I've got to play it defined risk. And honestly, you know, I think I'll just pick one side of the trade as far as direction. So a lot of times I like credit spreads, and it really doesn't matter. Put credit spread, call credit spread, either one would work because most of the time either one will work if the stock doesn't move much. So I'm thinking about selling the 24 delta put, then buying the put $5 below. That's a 127 credit. So you're risking 373 to make 127, right? So pretty decent as far as a ratio, 3-to-1, which is about as low as I want to go on a put credit spread. If I wanted to bump that up, you know, I could sell the 155 strike, buy the 150. Now I get a 170 credit against a max loss of 330. Either one of those is fine. Now, this is a very tiny trade, right? A $5 wide put credit spread is a small trade, which is perfect for those of you that are trading with smaller accounts. That's why I often use these as an example. You want to make the trade bigger. It's really easy to make the trade bigger. Instead of doing a $5 wide spread, do a $10 wide spread. Now you're risking about 700 to make 300, right? You made the trade twice as big. You want to make it even bigger, make it a $25 wide spread. Now, if you're going to do this, I wouldn't keep the short put at the 29 delta. I would go treat this more as a naked put. So my naked puts, I often go at least to 20 deltas, maybe 16 deltas. Let's go 20 deltas, the 145 strike, and then go $25 wide, and we get 363 credit on a buying power reduction of $2,100. That's your max loss, right? Well, your buying power reduction is actually only $1,500, so they give you a little buying power relief on that. But still, max loss $2,100 against a 363 credit, pop of 76%, P50 number of 87%. So all of those put credit spreads work. Again, depending on your account size and what you're trying to risk on the trade, you can size it however you want. If you want to do the call credit spread side, you certainly can. Again, either one works because they're out of the money. And ARM, very volatile stock, has a lot of volatility. And chances are, whether you do the put credit spread or the call credit spread, at some point over the life of this trade, you'll have a chance to profit on either side of the trade. For me, though, I'm going to go with the put credit spread side because semiconductors have been strong here in the last couple of years. And, you know, that's just the side I think I'm comfortable playing this time around. So that's it for this week's edition of Weigh the Options. Again, Weigh the Options is published immediately for members of the channel. And you really want to get immediate access to these trade ideas because if you wait a week, well, these trades are no longer viable. So please hit the join button and help support the channel. Peace, guys.